Mm-hmm. Hello, this is Mitch Goldberg. Welcome to Be the Boss of Your Money. This is the show, the live stream, the podcast where you go to learn about personal finance, investing tips, and business and other relevant subjects that have to do with making you the best possible version of your financial self. Be the boss of your money because I want you to be the boss of your money, not your money to be the boss of you. I'm Mitch Goldberg with Client First Strategy. Today, we had a big rally in the market, big rally from the last couple of days, big sell-off followed by one of these days. Is today a one-hit wonder? A bounce that gets wiped away the next day only to make lower lows? Was today a head fake? Or is today just the beginning of a new leg higher and we can all breathe a sigh of relief? That's what we need to talk about today. But ultimately, the point of this show is to give you a way to win, to beat this massive volatility. You could beat it. I'm going to tell you how. It's not that hard, but that's what I want to do. I'm going to make you a better investor. Listen, I've always said it's worth repeating. You become a better investor in down markets than up markets, because in an up market, all of your beliefs are validated. You're right. Stocks went up. You're right. How could you be wrong? It's a down market when things go lower, when you find out that you weren't so right, when you actually question what you're doing and what you're doing right and wrong. That's how we learn. So let's roll the quick intro, and then we're going to get into this. First, a quick update, and then I'm going to give you the goods. Here we go. All right, we are back. Thank you for joining me. If you're just joining us now, this is Be the Boss of Your Money, the place you go to learn about personal finance, investing tips, business, and other relevant subject matter. Be the boss of your money because I want you to be the boss of your money, not your money to be the boss of you. So let's do a quick share screen. We always start these episodes with a market update and perspective because we need to learn, and I want to teach you how to read the tea leaves. So today you see Dow up 439 points after being down over 600 yesterday. S&P up 67 points, up 2%. The NASDAQ up almost 3%. The Russell 2000 went up the least, up 1.45%. It was down the least yesterday of the major averages. The Russell 2000, a lot of people don't really follow this. I think you should. It's the small cap stock benchmark. And then there's the VIX. That's also known as the fear gauge. It basically tells you, directionally speaking, whether or not professional investors are paying more money or less money to hedge their bets in, to hedge against downside risk. So the fear gauge is below 30. That's an important indicator to me. Down 8% at down a little over 2.5 points, down to 28. We really need to see this go below 25 for a decent sigh of relief, and that would maybe tell you that the quick downdraft we had the last few days really is just a pause that refreshes, as opposed to heading to new lows. Or lower lows, I should say. Now, I'm not saying we're going to the March 23rd low, but definitely the market's up a lot, hit all records in the S&P and the NASDAQ. Would be surprising to me personally to see things go lower, even after today's bounce. I don't think today's bounce validates anything except that the market was due for a bounce after a couple of really down days. The NASDAQ dropped 10% in 3 days. That's the fastest the NASDAQ ever went into correction territory in its history. 10% is the definition of a correction, 10% drop. 20% drop is the definition of a bear market. That's, we need these numbers to make sure we're all on the same page. So let's take a quick look here. We'll look at the FANG M stocks. Facebook was up. Apple rebounded. Amazon rebounded. Netflix was off a little bit. But Google was up. That's Alphabet. Microsoft was up. These stocks certainly were not up as much today as they were yesterday, as much as they were down yesterday. But still more good than bad. And when you have such big companies do well, that typically will have the effect of lifting the entire market, which they did today. So a big rebound in techs, but basically a rebound in almost everything. Let's take a look at the reopening stocks. Here's a place we didn't get a rebound, but reopening stocks have been doing relatively better than the work from home, stay at home tech cohort. Today that reversed a little bit. Planet Fitness was up barely. Then Marriott Hotels down, Royal Caribbean, Delta Airlines, Southwest, Norwegian, United Airlines, Carnival Cruise, Cinemark, that's a movie theater chain, American Airlines. So that's my reopening list. So today was more of a day about technology and money rotating back from the reopening stocks into the tech sector. Just to prove to you, further illustrate this is what I look at every day. This is the most important dashboard that I look at every day. We have 11 sectors of the S&P 500, and these are the major ETFs that track each sector. These are all indexes. They all track an index. You cannot invest directly into an index, but you certainly could invest in a security that tracks or mimics an index. So we've got technology leading the way, up over 3%, followed by building materials, consumer discretionary, rounding out with XLI industrials. So you see the industrials up over here, and then toward the bottom are financials and energy. I always say this, I sound like a broken record, I know, but you want financials to lead the way. The financial sector is the central nervous system of our economy. If financials are going up, that's typically a good sign that loan demand is going up, economic activity is going up. It's something we'd like to see. We'd like to see financials go up. So they didn't, but nonetheless, every sector today was up, so you can't argue with a good day. So let me just stop screen sharing for a moment. I want to talk to you about a couple things today. So if you looked at the introduction to today's episode, I know, by the way, there are a couple of comments out there. Hey, Ruff, good to see you. Wealth is created in down markets. Yes, absolutely, Anthony. It certainly is. And it's also created by hanging on for the long term, right? So we always want to get better prices, but we know we can't control that. I know you know this, and you are an expert. And nice intro. Thank you very much, buddy. Really appreciate that. You are a good man and a friend. Thank you. So let's just talk about a couple of things. If you looked at the intro to today's episode, it was about confusion, conflicting advice that we're getting from market soothsayers. What are the experts saying to do right now? Okay, so we have that, and with so many choices, so many investment choices, there's no excuse anymore to not have a portfolio that's appropriate for you based on your needs, on your financial goals, your time horizon, and your risk tolerance. There's just an endless amount of mutual funds and exchange traded funds that give you exposure to international stocks, domestic stocks, large cap, small cap, mid cap, different sectors of the market, bonds, etc., municipal bonds, treasuries, corporate bonds, short-term bonds, long-term bonds, intermediate-term bonds. You have so many investment choices and such easy access to it that I find it like incredulous to see an investor with a portfolio that's not right for them. Now, a lot of people are in a portfolio that's wrong for them, but they don't know it. And the reason they don't know it is because their portfolio is going up. Well, how could a portfolio not be right for me if it's going up? Obviously, something that's going up is always right for me. But you have to look at the risk. So does that mean if the portfolio, are you making a binary decision? If the portfolio goes up, it's the right portfolio for you. If it goes down, it's the wrong portfolio for you. Because it'll go up and down, up and down, and up and down. That's a terrible way to make a judgment on what's right for you and what's not. So we're going to talk about that a better way. We're going to talk about work from home, reopening stocks, and the fact is, you probably need to own both, right? Diversification, we talk about this. That doesn't necessarily diversification doesn't necessarily protect you from a down market. Your portfolio will still drop in a generally down market, but it does prevent your worst investment from becoming your entire return. Diversification is not a strategy for return maximization. It's a strategy we use for risk minimization, right? There's a difference, okay? So we should always know what one does and what the other one doesn't, okay? So let's go on, and I want to show you some of the things that are causing a lot of investors some confusion. Go back to the share screen. Share this. Share. And we're here. Okay. Right here, Ed Yardeni. Now, Ed Yardeni is well known. He's known to be a very accurate market soothsayer, economist. He's the one who coined the term bond vigilante. It's just, he is one of the all-time market greats. And by the way, I'm happy to say that he and I have actually been quoted a few times in the same CNBC articles. Kudos to me. Hope I didn't take Ed's cool factor down at all. But you could follow Ed Yardeni on LinkedIn. He puts out a ton of great content. You could tell he's somebody who enjoys putting out a lot of content, a lot of video content, a lot of written content, very educational. And he writes in a way that I think is, most investors will have no problem absorbing, all right? But he says, so far so good. It says a pullback is healthy and lets earnings catch up to stocks, but sounds pretty bullish, pretty optimistic to me. Jim Cramer says investors with cash, if you haven't bought anything, maybe you dip your toe in. So a little kind of bullish, moderately bullish, saying it's more of a buy than a sell in that title and the article. And then you have James Bianco, who is another excellent person to follow on LinkedIn. And he says the most painful pullback since March is just starting. So he doesn't see this bounce as anything more than just a short-term bounce on the way to lower lows. And then Stanley Druckenmiller, who is one of the most famous and well-respected investors of all time, hedge fund manager, says the stock market is in an absolute raging mania. Sounds pretty bearish to me. So who do you listen to, though? Do you listen to Yardeni and Cramer? Do you listen to do you listen to do you listen to Bianco? Do you listen to Druckenmiller? These are really all of these people are very smart people, and I think in this case it doesn't really. I could stop sharing the screen now. I don't think it really should matter to you, because if you are going by someone's advice in that regard, it's a little confusing. Well, should I buy? Should I sell? What should I do? And I started this episode by saying, I want to give you a strategy that'll help you that'll help you outrun volatility. All right. Short-term volatility, though, maybe this is a better way to say it. Short-term volatility is like the shadow of the market. And you can't outrun your shadow. Maybe on a cartoon you could, but not in real life. You can't outrun your shadow. Many people have tried. I guess another way of saying is you can't outrun your past. It always catches up with you. All right. So I don't think you should go by either one. Either, hey, you should buy stocks here because stocks pulled back and they're cheap. You should sell stocks here because they're going lower. That's not investing. Most of the people who are watching this are not traders. You are somebody who's looking to become better financially. You are somebody who is looking to prepare for retirement, to send your kids to school, to become a better spender, better with your personal finance, maybe a higher earner. There's a lot of reasons why you watch this, but usually it's not because you're looking to day trade the market or to make a binary decision of up or down, over the next few hours in the market. So what I suggest here is this. There is no reason for anybody today to not have an investment portfolio that is appropriate for them based on their time horizon, their financial goals, their risk tolerance, because you have so many investment options, an endless amount of investment options that just weren't around 20 years ago. When I got started 30 years ago, you basically had stocks, you had bonds. Mutual funds were kind of a new thing. Hardly anybody had access to a 401k plan, and an IRA contribution was actually limited to $2,000. Can you imagine trying to build a retirement fund for retirement? Obviously retirement fund is for retirement, but can you imagine trying to build up a retirement plan with contributions that are limited to $2,000 a year? No way. All right, so there's no excuse anymore to not have the right portfolio for your situation. Everything is subject to change. Portfolios need to be monitored. Economic conditions change, market conditions change, and your own personal finance changes. My feeling, though, is I don't like to make investment changes because of a whim, because I think the market's up too much or down too much. To me, an investment portfolio is monitored and changed according to two basic things. One is rebalancing. So if somebody's risk tolerance dictated that they have a certain amount of exposure in their portfolio to stocks, for example, and stocks go up a lot, we would scale back the stock exposure. This is the international sign language for scaling back stock exposure. And we would raise the bond exposure. International sign language for raising the bond exposure. Okay, so that is what you would do. You'd rebalance. And the other reason to make a change in a portfolio, and to me this is a very legitimate reason to make a change, is because of changes in your personal finance. You get married, you have children move out of the house, your children get married, you have in-laws, you have grandchildren, you retire, lose your job, get a new job, make more money, sometimes make less money. These are all factors that take into account changes in your portfolio. You don't base changes in your investment portfolio because you bought a stock that said it's going to split 5-for-1 and goes up a lot. So now you're making you're making changes to your personal financial plans because of a stock. And you know that a lot of these run-ups in these stocks are ephemeral. They don't last. Sometimes they do, sometimes they don't. But is it in you to accept that kind of risk? This all comes with risk, right? So that's the story of the day. And that, to me, folks, is really how you beat volatility over the long term. What good is an investment portfolio if you can't stick with it? Some people make their decisions, or let me say this. I don't like investment decisions based on all in or all out. I don't like to see investors make an investment decision by saying, I'm going to sell all of my stocks, for example, and I will put that money back into stocks when the stock market goes even lower. Because what happens is that if the stock market does go lower, then you're going to say to yourself, well, now that the market's going even lower, I'm going to wait for it to stop going lower. And you don't invest. And then the stock market rebounds. And then you say to yourself, well, I could have bought stocks lower. So I'm going to wait till they go back down again. And then they go down. And then you say to yourself, wait, they're still going down. They're going down lower. I'm going to keep waiting. And then they go back up. And you say, they're up again. I could have bought when they're lower. I'm going to wait for stocks to go lower. And what happens is you get into endless procrastination. That's not a strategy. That doesn't work. Time in the market, not timing the market, is what actually works when it comes to building wealth over the long term. I like to call it the get rich slow scheme. Practicing good financial habits, personal financial habits, investing over the long term with a portfolio that you could stick with over the long term. You can ask any financial professional what's the most important determinant in your investment returns. It's not how well you've traded over the years, because you're probably not going to do that well at all. The important thing is your stick-to-itiveness. The important thing is sticking with your portfolio over the long term. Now, if you don't like a lot of risk, you're somewhat risk averse, you could have a portfolio with a lower risk profile. But the key is to have a portfolio with the right risk profile that you could stick with, so that when we have these giant down swoons in the market, you won't be tempted to sell and get out of the market and miss out on reinvesting dividends, compounding, long-term rebounding, and bull markets, because those are ultimately the conditions that will help you create wealth over the long term. I'd like to thank you for watching. If you have any questions, certainly hit me up in the comments. If you're watching this in the replay, welcome to you as well. And I look forward to seeing your comments too. Thank you very much.